It's 11:47 p.m. and Marcus is sitting in the back office of his HVAC company, staring at a loan rejection letter. 13 years in business. Never missed a payment. Perfect credit score. And still, the bank said no. Sound familiar? Because you're not alone. In fact, you're in the majority. Here's the signal every small business owner needs to hear. Traditional banks are approving just 22% of loan applications. 22. That's not a hurdle. That's a wall. Meanwhile, Fintech lenders, they're approving 35 to 47%. Nearly double. And in 2026, they're funding loans in less than 2 days. So, what changed? And more importantly, how do you use this shift to actually get the capital you need? That's exactly what we're breaking down today. Let's start with the numbers, because they tell a story. The U.S. small business loan market, over $1.4 trillion. Trillion with a T. And that money's flowing through more channels than ever before. Banks, credit unions, online lenders, and now, the platforms you already use to run your business. A decade ago, online lenders held single-digit market share. Today, they've captured nearly a third of all small business loan originations. That's a fundamental shift in who controls access to capital. According to Federal Reserve data analyzed by Crestmont Capital, large banks, we're talking assets over $10 billion, approve somewhere between 15 and 25% of small business applicants. Community banks do better, 40 to 55% approval rates. But here's the thing, how many of you have a community bank branch within 20 miles of your business? Now compare that to online and fintech lenders. 35 to 47% approval rates, nearly double what the big banks offer. Why such a massive gap? It comes down to how they evaluate you. Banks built their underwriting models for large borrowers, million-dollar credit lines, multi-year financial statements, commercial real estate as collateral. But small businesses don't operate that way. Your cash flow is lumpy. Your revenue is seasonal. You reinvest profits instead of hoarding them. The traditional model wasn't built for you. Fintech lenders flipped the script. According to Federal Reserve research, they analyze cash flow patterns from your bank statements, payment processing history, even your industry trends. They look at digital business metrics instead of just FICO scores and years in business. It's a fundamentally different way of assessing risk, one that actually matches how small businesses operate. And the market noticed, 74% of small business owners now choose non-bank and online lenders over traditional banks. The primary reasons? Speed and simpler applications. Here's a number that would have seemed impossible 5 years ago. AI-powered underwriting now delivers funding in 1.8 days on average, less than 2 days from application to cash in your account. And by the fourth quarter of 2026, that's expected to drop to under 4 hours. 4 hours from I need capital to it's in my account. That's a revolution in access. But here's where it gets really interesting. The next wave isn't even about applying for loans at all. It's about loans finding you. It's called embedded lending. And if you use Shopify, Square, Amazon, or a dozen other platforms, you might already have a pre-approved offer sitting in your dashboard right now. These platforms see your transaction history in real time. They know your average order value, your return rate, your seasonality patterns. That data becomes your application. No uploading bank statements. No explaining that dip in revenue last March was because you took your first vacation in 4 years. The platform already knows your story. According to Crestmont Capital's market analysis, fintech companies generate 10 to 15% of small business loan volume. But here's what matters more. They serve nearly double the number of borrowers compared to traditional banks. Smaller loans, more businesses served, that's the trade. A typical bank might make fewer, larger loans to established companies. Fintechs spread that capital across thousands of smaller operations. Now, I want to be honest about the trade-off here. Because there is one, and it matters. Fintech loans often carry higher interest rates than bank loans. Sometimes 2 to 5 times higher APR. That's real money. That's a cost you need to understand before you sign anything. So, here's how to think about it. And your situation will absolutely vary. A higher rate loan that funds in 2 days might still be the right choice if the alternative is missing a contract that generates 3 times that cost in revenue. The question isn't just, what's the lowest rate? It's what does this capital let me do that I couldn't do before? Run the numbers on the opportunity, not just the cost. Now let's talk about what actually moves the needle on your approval odds. Because here's the thing, whether you're applying to a bank or a fintech, preparation matters a lot. According to Crestmont Capital's lending survey, businesses with complete financial documentation achieved approval rates 18 percentage points higher than unprepared applicants. 18 points. That's not a small edge. That's the difference between declined and approved, between staying stuck and moving forward. So before you apply anywhere, and I mean anywhere, consider pulling together your full documentation package, 12 months of bank statements, 2 years of tax returns, a current profit and loss statement. If you don't have clean financials, that's actually useful information. It tells you to spend a few weeks getting organized before you start applying. Don't waste applications on incomplete packages. Here's a practical approach many business owners find helpful. Check your embedded lending options first. If you're already using Shopify, Square, or Amazon, log in and look for pre-approved offers. These offers are based on your actual transaction history. No application, no credit pull, no waiting. If there's money waiting for you there, at least know what terms they're offering. If traditional bank lending is important to you, maybe you want that relationship where you're after the lowest possible rate. Community banks tend to be worth considering. Their approval rates often run 40 to 55%. Compare that to large banks at 15 to 25%. Same credit profile, dramatically different outcomes depending on who you ask. Geography matters here. For fintech applications, here's what the data suggests. Focus on demonstrating consistent cash flow patterns. Your credit score matters less than your deposit and revenue consistency over the past 6 to 12 months. Why? Because that's what their algorithms are looking for. They're trying to answer one question: can this business reliably service this debt? Cash flow tells that story better than a credit score from 3 years ago. And here's the bigger picture. Alternative lenders have captured nearly 1/3 of all small business loan originations, up from single digits just a decade ago. That's not a blip. That's a structural change in how capital flows to small businesses, and it means you have options your predecessors never did. Now, every business is different. What works for a 10-person service company might be completely wrong for a solo e-commerce operation. The principle holds, but the execution? That's yours to adapt. Here's one approach that's helped a lot of businesses. Compare the total cost of capital, not just APR. A fast fintech loan at higher rates may still cost less than the revenue you'd lose waiting 3 months for a bank approval. Time has a cost. Every week you spend waiting for capital is a week you're not expanding, not hiring, not fulfilling that big order. Calculate that into your decision. And before you make any significant financial decision, please run your specific numbers by a qualified accountant or financial advisor. The patterns we're discussing are helpful, but your situation has details that matter. If you found this breakdown useful, subscribing means you'll catch the next signal when it drops. We're here every week, watching the trends that actually matter for small business. Let's bring this back to where we started. Remember Marcus, the HVAC guy with perfect credit and 13 years in business staring at that rejection letter at midnight? His bank saw a credit profile. They didn't see 3 service trucks, a waiting list of customers, and 15 years of relationships with commercial property managers. 6 weeks later, Marcus got funded to a fintech lender who looked at his cash flow, not his file. Different numbers. Different numbers. That's the signal for this week. The lending gap is real, 22% versus 47%, but so are your auctions. Know who's actually likely to say yes before you apply. Get your documentation ready. Check your embedded options. And remember, the right capital at the right time can change everything. See you next week. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor or business consultant before making significant financial decisions. Remember, this content is for informational purposes only and is not financial advice.